Hello and thank you for joining me today. My name is Wesley Boudreau, one of the financial advisors here with the Retirement Group. Today we're going to go over the emotions of investing and talk a little bit about what drives a lot of investment behavior. This is one of the seminars that we spend close to an hour on, but we're going to go through the webinar and kind of cut this down to probably 10 to 15 minutes. So we will skip over a few different items here. But before I get started, again, if anybody has any questions or wants to update their cash flow analysis or take us up on that offer, we'll talk a little bit about today. Just feel free to give us a call at 1-800-900-5867. Now, for those of you that have not met us or haven't been to one of our seminars or sat down face-to-face with one of our advisors, a little bit of information about the Retirement Group. We are an independent financial advisory firm that focuses on helping transition corporate employees into retirement. We've been doing this for close to 30 years. We work with a little bit over 30 different companies on helping understand your benefits plans between the pension, the 401k, healthcare, and things of that nature. And our goal is to help make sure that you understand them yourself as you get closer to retirement and help you transition so that you maximize those benefits and don't make any mistakes in picking the wrong date to retire. Now, we do have offices throughout the country, so rest assured, once you retire, chances are we're going to have something close to you. We also, if you decide to move to a different state, we might have you covered there as well. Now, again, like I mentioned, our key focus is the knowledge of your companies. But one of the things we do provide, and I would recommend that you take us up on this if you have not done so yet, is our complimentary financial analysis. And this is essentially putting together a financial plan for you, which unfortunately about 3/4 of Americans nowadays do not have a financial plan. It'll only take us about 5 to 10 minutes of a few questions, and we'll get that report put together for you in a few days and get that back to you and set some time to go over it. And this is what we do in order to help determine when's the best day for you to retire. And we're going to talk about emotions today, so it's also a good way for us to kind of get a gauge for who you are and help you with the emotional decisions as far as investing and help you with reviews there as well. As far as working with employees, our goal is to help you in that transition process. And most of the companies we work with, AT&T included, you're essentially going to have 3 sources of income whenever you do retire. Number one is your Social Security, which you can take, generally speaking, as early as 62 or defer it to age 70. We do provide a Social Security analysis, so if you want to review that, we can run those for you as well to show you all the different claiming options associated with it. You're also going to have your 401k, which you and AT&T have been making contributions to over the years, and that's a defined contribution plan because those contributions are set, but the outcome moves with the market. So depending upon what you've done, it'll determine what your assets are upon retirement, and you can use those to supplement your income. Now, in addition to this, you have your defined benefit plan, which is a pension plan, and that's going to pay you an income for the rest of your life on a monthly basis, or you may have the option to actually take it as a lump sum. Now, I mentioned that cash flow analysis. We use those to tie all this information together, especially if you're trying to determine the right day to retire, as well as determine whether you want to take a lump sum or an annuity on your pension. So we're not going to cover that today, but again, we've got other webinars on that. But more importantly, give us a call at 800-900-5867. We'll be happy to go over those choices with you as well, especially with a lot of things coming down the pipeline with AT&T. Now, as far as the finance and the emotions, there's really 2 theories associated with finance. There's a standard theory and behavioral theory. Standard theory is that everything's pretty much efficient. Investors are rational beings and they consider all information accurately before making any decisions. And it also assumes that markets are extremely efficient, meaning that they quickly incorporate all known information and they represent all true value of securities. Now, all this is good in theory, but unfortunately, when we factor in individuals and behavior and emotions, things do change. And that's why there's behavioral finance, which kind of builds upon the standard finance theory, but as the fact that investors are not totally rational all the time. They often do act based upon imperfect information. They do make mistakes. And the markets they may be difficult to beat in the long term. And a lot of times in the short term, there could be excess returns because of different anomalies associated with the markets. And so today's focus for this webinar, again, is going to go over some of the different behavioral aspects that we do see from time to time. Now, the reason it is important to understand behavioral finance is if you can understand yourself better, you can actually better understand the best ways to invest, as well as the best day to retire. Now, for the best day to retire, again, that's running that cash flow analysis where we can compare multiple dates for you to help you determine the best day to retire, so you maximize your benefits and don't leave any money on the table. But also, behavioral finance will help you understand and develop better investment strategies. Will help you stay the course when it comes time to investing. Make sure you don't jump off when there's some shakeups in the market, which could be detrimental over the long term. And it's just overall going to improve your investment experience, having a little bit better idea of what's actually going on and making sure that that you don't make any quick reactions. So some of the different characteristics of behavioral finance are here. We're not going to go over everything today again because this is an abbreviated webinar. But some of those topics, we cover all these in the seminar, are going to be loss aversion, narrow framing, anchoring, mental accounting, diversification, disposition effect, herding, regret, media response, and optimism. So some of the ones we'll cover today would be diversification. One such thing of diversification is actually naive diversification. And that's pretty much associated with just diversifying based upon what's provided for you in your plan, your 401k, for instance. Now, we do a lot of work with individuals, and because there's fewer choices in 401k plans, a lot of times once they retire, we help them roll it over to an IRA, where you've got many more choices associated with your investment selections there. So it eliminates naive diversification. But if we take a look at 401k plans, or 403bs for that matter, if we look at historically, when they first started out, TI-CREF did a lot of 403b business. Their plans were extremely simple: one stock fund and one bond fund. So naturally, most of the individuals in there were roughly about 50-50 between stocks and bonds, because they thought that that's what TI-CREF wanted them to be. Now, the TWA pilots from years back, they actually had a little bit more. They had 5 stock funds, and they had 1 fixed income fund or 1 bond fund. So they ended up being about 75-25, because again, they saw there was more stock selection, so they overweighted that. And the flip side was true for the University of California, in which case they only had 1 stock fund and 4 fixed income funds. So people were a little bit more conservative, only having about 34% stock and about 66% bonds. Now again, this is naive diversification because you're simply just looking at the diversification based upon what the account provides you, and not what your actual situation is. Now, as far as this, you need to make sure that you are properly diversified, and don't let investment options dictate your asset allocation. So again, don't just simply look at the plan and look at the options to determine your allocation. I've come across somebody who actually had about 100 choices in their 401k plan, and sure enough, they had 1% in every single choice. Now again, working with the retirement group is a good way to help you determine your asset classes that will maximize your return and reduce your risk. So again, when you have time, just give us a call. We'll be happy to run a 401k review, let you know about the options within the plan, and possibly options outside the plan, depending upon if you have any option 1 rollover options. Now, mental accounting is another situation we tend to see a lot of times with 401k plans, and a lot of that has to do with separating and mentally accounting different sectors of the market, or different stocks versus bonds. Now, when we look at plans that do not offer company stock, we tend to see usually about a 50-50 allocation between equities and fixed income. And when you do introduce the fact that a company has a company stock in the plan, like AT&T would, for instance, we tend to see a much higher allocation towards stocks, simply because between the company contributions and your contributions, you may put a large chunk. The average is actually up close to 40% into the company stock. Then another 30% in fixed income, and 30% in stock. So you're 50-50 between those. But because of that company stock, your overall allocation has gone from 50-50 to about 70-30. So again, this is the company stocks placed in a separate mental account from the other options when you take a look at it this way. Now, herding is one of the issues that we do run across quite a bit, especially with retirees. And investors do have a herd behavior. A lot of times that's looking at media responses or chasing returns. There's a line study. We're not going to go through that today, but we do go through it in the webinars that goes into greater detail of herding. But one of the biggest issues we're seeing right now, and we've seen over the last few years, are just the people retiring or taking offers with their coworkers. Again, a lot of times we're going to see offers. It looks like we're possibly seeing some right now with AT&T in different departments. But what's going to happen is you may have a package, in which case it may look advantageous for you to retire early. But again, it's our job to run that cash flow analysis to compare maybe your original retirement date that might be 3 years out versus now in the package to see if it makes more sense for you or if you can retire. However, we've seen a lot of people that really cannot retire and they should work another 3 to 5 years, for instance, but all their buddies are retiring, so they're essentially taking the package as well. And it's kind of a naive decision because they're just doing it they're hurting with everybody else. And in the end, they're going to be actually hurting because they're not going to have enough assets to survive retirement, or they're going to have to reduce from their spending or look for a different job. So again, it's very important to review that situation if you do have a package and you want to look at taking that. Don't just follow the crowd. Also, another hurting behavior is just simply chasing returns or chasing the ratings of mutual funds. A lot of times people will use the Morningstar ratings and follow the 4 and 5 star funds, which unfortunately very rarely do you see a 4 and 5 star fund stay that way for 5 or 10 years. A lot of times today's 4 or 5 star could be tomorrow's or next year's 1 or 2 star or vice versa. So again, working with a company like the Retirement Group, we can help you determine and review the actual funds, not just by the Morningstar reviews, because again, those are historical and they're not forward-looking as well. And again, ratings, they have a lack of predictive value because of that. So again, just be very careful about hurting and following the crowd. Another issue we run across is just general optimism. It's good to be optimistic. I'm optimistic. My wife's pessimistic sometimes, but ultimately speaking, what you want to look at is being a little bit careful of being too optimistic about your situation. Most people believe that it's likely that good things will happen to them and bad things will happen to others. They do believe that others are more likely to run out of money or lose their job, but in reality, sometimes that could happen to you as well if you're not careful. And a lot of times, an optimistic person believes that others are less likely to become rich or become famous. Not to say that you think you're going to become rich or famous, but again, just generally speaking, we're optimistic about things, and need to be a little bit more. Need to make sure we review our portfolios more often, and not just be optimistic about the market continue to always climb. So that's just some of the different emotions that we do run across. The next steps that we do suggest that you do discuss a financial plan with us. I mentioned a few times about that cash flow analysis, especially if you're within 5 years of retirement. Make sure you do understand the risk and return when it comes to investing, and avoid different big mistakes. We go through a lot of these in the actual seminar, but we can discuss some of these one-on-one as well. The 5 concepts we didn't cover today, but we do go through that in the seminar. And ultimately, if you do need help, make sure you do choose an experienced team of investment managers and not just an individual, and make sure that you and they are continuing to monitor and optimize your portfolio. It's not just a set it, forget it, one and done situation. You need to be on top of it, every year and every week. Now, we do recommend if you are working with another advisor, that's great, but we do recommend taking us up on a second opinion. We actually recommend our own clients do this every few years or so. But if you are working with somebody, make sure a couple things are covered. Make sure they do offer a complimentary detailed financial analysis. And we talked about optimism. Make sure it's not optimistic. Make sure that it's a conservative analysis. We run ours very conservative, making sure that you're going to survive retirement through that. And make sure that they understand your benefits, whether it be the 401k, the healthcare benefits, the pension. Make sure they understand the options. If they don't, again, run that cash flow analysis with us so we can help you determine the best day to retire. Make sure you understand their fees. Everybody has a different fee structure. A lot of times, we come across individuals who think they understand their fee structure and realize that they actually don't, and they may be getting nickel and dimed in some areas that they weren't aware of. And we are fiduciaries, so again, it's our job to be transparent on everything. We're not a one-size-fits-all where everybody goes into the same cookie-cutter approach. And we are transparent on our fees, and those fees range anywhere from 0%, so $0, all the way up to about 1%, depending upon what you're doing. But our job is to determine what your needs are, back into that, and provide you with maybe 2 or 3 different choices, and go through the pros and cons associated with that, and help you determine the best option for you. And just figure out what it is you value. Make sure that they do provide that, whether you're looking for tax assistance, a good website, rate of return, things of that nature. Rest assured we can take care of that for you, but just make sure you know what it is that you're focused on more heavily than others. So with that, I want to thank everybody for taking a little bit of time out of their day and joining me today. Again, my name is Wesley Boudreau, one of the advisors here at the Retirement Group. And should you have any questions or want to run that cash flow analysis or update one if it's been over a year, again, just give us a call at 1-800-900-5867, and we'll be happy to do that for you. I want to thank everybody for joining me, and I hope everybody stays safe.